Hi everyone, welcome back to the channel. My name is Prem and you're watching Power of Pivots. So, as you have already seen in the thumbnail, in today's video, we are going to discuss the different type of days that happens in the market every day. Now, if you are into day trading or investing or just follow the stock market in general, then you already know that the market moves in two phases. Number one is the trending phase and number two is the trading phase, also known as range bound phase or the sideways market. It is said that the market is trending only 30% of the time and rest 70% the market remains in the sideways phase. Many traders and investors who are new to trading often lose their entire earned profit as well as their entire capital just because of not being able to distinguish between the market phase in which they are trading. I also lost a huge amount of my wealth into trading when I initially started just because of not being able to identify in which market phase I am trading. But now, after so many years of market experience, I finally classified the market days into 6 main types. They are number 1, a trend day, a double distribution day, a typical day, a expanded typical day, a sideways market, and a trading range market. In this video, we are going to discuss all these 6 different market days in brief, and at the end of the video, I am also going to give you the live market chart examples so that you can understand these days in a much better way. The best part about this video is going to be we are not going to use any indicators, rather we'll use pure price action for the identification of these days. So let's move to the screen now. Alright guys, now we are looking at the screen. So without wasting a single second of yours, let's just dig deeper into the video. So when we talk about day trading, it is very important for a day trader to understand in which kind of market he or she is trading. Now there are two kinds of trading days. Number 1 is trending market and number 2 is the sideways market. Apart from these two market types, I have classified the Indian stock market into 4 different type of days that comes and fall under the category of these two market, trading and trending. So now let us discuss the different types of days that happens in the market. The very first day we are going to discuss is the trending market or the trend day. So a trending market or a trend day is a market in which the price either moves upwards or the price either moves in the downward direction. Now the next question that comes to our mind is how to recognize that which day is going to be a trend day and how to trade them. So to answer that question is whenever the market opens gap up or gap down, it is often seen that the market is converted into a trending market or a trend day. Of course, the direction in which the market is going to move will depend on the price action of that particular day. So once you have recognized the day in which you are trading, the next question is how to take a trade in that particular day. So always remember, the market never moves in a 90-degree angle. It always gives some pullback and then continue its own journey. So every pullback is your buying opportunity. Now the next day we are going to discuss, I personally like to call it as double distribution day. A double distribution day would be seen as similar as to a trend day to some of you all. But it is not, rather it is completely different from a trend day because of its indecisive nature. The market opens at the same price level where it closed previously, the previous day, or slightly gap up or gap down. During this type of day, the market will usually open the session in a quiet manner, trading within the firmly tight range of the first hour of the session, thereby creating an initial balance that is very narrow. Suppose these are the 15-minute candles. So the very first 4 candle over here gives you the initial balance high and the initial balance low of the day. Now, what happens in double distribution day? The initial balance range is so narrow and so tight that the price eventually breaks the initial balance either higher or either lower in order to find or seek new values. After seeking those new values, the market goes into consolidation again, where it forms the second distribution of the day, either higher or lower. Now, the third type of day that we are going to discuss is known as typical day. Now, a typical day is quite easy to recognize because of its wide initial balance that it established at the outset of the day. Now, if you trade in stocks, you would have noticed that sometimes what happens, the market rallies or drop sharply. Now, this can happen because of some news, global news, or because of some aftermarket orders that are being executed. Now, as a result of this, the market ends up making a very wide initial balance for the day. The market participants try to bring the price back to its fair value, but it is often seen that when the price rallies in a particular stock, it trades at the top initial balance for the rest of the day. And if the price drops sharply in a particular stock, then it like to trade at the bottom initial balance for the rest of the day. So this is how somewhat the typical day looks like. We are also going to discuss these days on the live market chart, but for now let's understand how these days work. So the price rallies in the morning, creating a very wide initial balance. The market participant try to bring the price a bit lower, but eventually the price always stays and trade at the top initial balance for the rest of the day. In case the price drops, then the vice versa or the reversal of the same is seen. The width of the initial balance of a typical day is so wide that it becomes very difficult for the market players to bring the price back to its bottom initial balance. Now, the next day that we are going to discuss is expanded typical day. So, the only difference between the typical day and the expanded typical day is that market unable to reach the opposite direction of the initial balance in revenge to that breaks the initial balance that is nearest to it and moves higher or lower. If the price drops sharply and forms a typical day, then the expanded typical day would be said only when the price breaks the lower initial balance and moves lower and find or seek new values. Mostly, it is seen that the price breaks the initial balance and forms the expanded typical day in the very late hour of the trading day. Now, the next day that we are going to discuss is known as trending range day. Trading range day or trading range market is as similar as to the sideways market, but the only difference is that the buyers and the sellers are actively auctioning price back and forth within the day's range. When the initial balance high and the initial balance low is made for the day, the buyers are available at initial balance low, whereas the sellers are available at the initial balance high. Buyers, when the price reaches the initial balance low, buy that particular stock or index which pushes the price to go higher, where the sellers are sitting at initial balance high. They sell the particular stock or index over there which pushes the price to go down to the initial balance low. Now this buying and selling continues until the time of the last closing bell sounds. So this is somewhat how the trading range day looks like. The buyers are available at the initial balance low to bring the price higher, whereas the sellers are available at the initial balance high to bring the price down. So now the last day that we are going to discuss is sideways market or a sideways day. So what happens in a sideways market is that there is no active participation of any buyers or sellers. The price moves from one direction to another uncertain direction without any convictions. Traders have often lost their entire earned profit in a sideways market. A sideways market is said to be a non-directional market. It is also said as a consolidation period or a correction period. Volume, which is a very important trading factor or indicator, mostly remains flat during a sideways market because it is equally balanced between the bulls and the bears. Now, it is my firm belief that not every trading day should be a trading day. Many traders believe that since they are traders, they must be in a trade at all times. You should only trade when the circumstances are the most favorable for a profitable outcome, and in a sideways market, it is often difficult. So this is somewhat how a sideways days looks like. So now let us see the specific days on the live market chart for the better understanding. The very first example we are going to see is for the trending markets. This is Nifty's chart on 30th of August. Let us see how the index behaved on this particular day. As you can see, the market opened gap up, which is also the very first requirement for the day, as we have discussed earlier in the video. The market started its upwards journey, gave us a small pullback over here, which is also our buying opportunity, and look how the market goes on to continue its upward direction after the pullback or from the price that we have entered, giving us more than 1:2 risk to reward ratio. Let us see another example, but this time in a downwards trend in HDFC Bank. As you can see, the very first requirement of gap up or gap down opening was filled by the market. The market opened with an inverted hammer, which is considered as a bearish candlestick pattern. The very next candle was a bearish candle and had eventually taken out the low of the very first candle, giving us a signal for a short entry. Placing the SL above the high of the second candle, one could have eventually entered into a trade by going short. As you can see, there was no looking back for the market from there on. If by any chance a trader would have missed the very first entry, there were multiple pullbacks given by the market for the traders to enter short on this particular stock. So let us see some examples for double distribution day as well. This is Bank Nifty on 8th of July 2021. Let's see how the index behaved on this particular day. Now, as you can see, the market fulfilled the first two requirements of the day. The price opened slightly gapped down and made a tight and narrow initial balance for the day. The market finally break the initial balance low at around 12 o'clock in the afternoon and seek new lower values where it distributed or consolidated again. Now let's see another example in Tata Steel. As you can see over here in Tata Steel as well, the market opened where it closed yesterday at the similar price range then made a narrow and tight initial balance again, broke the initial balance low, seek new values, and the market went into distribution or into consolidation again. So now I assume that you would have got the basic idea of what double distribution day is all about. Now let's have a look on some examples of typical day as well as expanded typical day. So here there's a stock of Hero MotoCorp. Let's see how the stock behaves on 3rd of September 21. So as you can see, the stock opened with a very wide initial balance, which was the first requirement of the day. After that, the stock traded for the entire day at the top initial balance of the day, showing the exact characteristic of a typical day. Now let's have another example of a typical day in Tata Steels. As you can see, the market opened with a very wide initial balance and then traded completely near the initial balance low for the whole day. Now let us also have a look on some expanded typical day examples. So now let's have a look at the stock of Tata Powers, which has shown a very nice and neat explanation of an expanded typical day. As you can see, the price opened with a wide or moderate initial balance. The price traded near the initial balance high for the rest of the day. But before the last bell of the market rung, the price broke the initial balance high and seek new higher price values before the market closes. So now let us also seek some examples for trading range days and sideways days as well. So now you are looking at Bank Nifty on 31st of August. Bank Nifty already gave a very good movement a day before, and therefore I was not looking for a big day today to happen. Rather, I was thinking for a typical day, trading range day, or a sideways market to happen. As you can see, the market opened with a moderate initial balance. The buyers were available at the initial balance low to get the price higher to initial balance high, whereas the sellers were available at initial balance high to push the price back to the initial balance low. Now, this back and forth movement of the price continued till the last bell of the market rung. So now, let us look at the examples of the last and the final day, which is the sideways market day. As you can see, the market opened with a nice and moderate initial balance. The market, after creating the initial balance low, tried to reach to the initial balance high, but failed in doing so and went into consolidation for the entire day. There was no clear conviction available in the price movement. It was completely a non-directional day. As it is said in trading that not every day is a trading day, and therefore I will ask you to avoid taking trades in a sideways market, because traders who earn a good profit in trending market often lose their entire earned profit as well as the capital in a sideways market. And because of this sole reason, it is better to avoid trading in a sideways market and preserve your capital for the upcoming days. So I hope that I would have added some value to your trading, and I would definitely advise you to add these 6 different market days in your trading arsenals and look for them in everyday trading. Always remember, knowing the type of day in which you are trading helps you to cut down your losses and prevent you from taking an unnecessary and unplanned trades. If you like the video, do give it a thumbs up. It helps the channel to grow. Also, share your valuable comments in the comment section down below and tell us on which topic you want the future videos to be on. Also, consider subscribing to the channel, and I will see you on the very next video. Until then, keep trading, keep earning.